Good afternoon. I'm Taisei Inoue, founder and managing partner of Inoue Growth Partners. Today, I will introduce Japanese SME Productivity Growth Fund 1, a 30 billion yen growth equity fund investing in Japanese B2B SaaS company that improve the productivity of small and mid-sized businesses. We plan to invest 2 to 4 billion yen in each of 8 companies, acquiring 20 to 40% ownership. We will not use acquisition leverage at entry. Returns will come from revenue growth, margin improvement, and operational execution. We target a gross IRR of 20 to 25% and a gross MOIC of 2.5 to 3 times. Our key advantages are proprietary sourcing and AI-enabled operating playbook and workflow to finance expansion. The opportunity is supported by force structure trend. Japan's labor shortage is increasing demand for productivity tools. Many SMEs still use paper-based processes and outdated systems. Adoption of cloud finance, HR, and workflow software continue to expand. At the same time, the market remains fragmented, creating opportunity to build category leaders through organic growth and selective M&A. AI adoption and strategic buyer activity make this an attractive time to invest. We target Japan headquarters B2B SaaS companies with annual revenue of 2 to 10 billion yen and growth above 20%. We require at least 80% recurring revenue, gross margin above 70%, and all of at least 105%, and monthly churn below 1%. Companies should be profitable or able to reach break-even within 12 months. We invest for 20 to 40% ownership and underwrite to at least 2.5 times MOIC and 20% IRR. We avoid pre-product businesses, companies with weak customer retention, and highly leveraged transactions. Inoue has 4 advantages. Regional banks and accounting firms help us source opportunity before a broad auction. Our operating playbook improves sales, pricing, cross-selling, and AI automation. Our local team brings experience in Japanese B2B software. Finally, disciplined underwriting limits downside risk because we don't rely on leverage or aggressive valuation assumption. This combination allows us to create value rather than simply pay for growth. Project Circular illustrates how our investment strategy translates into returns. At entry, the company generates 4 billion yen in revenue and is growing at 20% annually. At 3 times revenue multiple, the company has enterprise value of 12 billion yen. We invest 3.6 billion yen for our 30% ownership stake. Our value creation plan including expanding sales through partner channel, cross-selling finance and HR products, automating back-office workflow with AI, and introducing payment and fintech services. If revenue grows to approximately 10 billion yen over 5 years, while the exit multiple remains unchanged at 3 times, the company exit value reached approximately 29.9 billion yen. Our 30% stake would generate proceeds of approximately 9 billion yen, resulting in 2.5 times gross MOIC and 20% gross IRR. Importantly, this return doesn't depend on the leverage or multiple expansion. It is driven by fundamental business growth. Our target fund size is 30 billion yen. We will construct a concentrated portfolio of 8 companies investing between 2 and 4 billion yen in each businesses. 20% of fund will be reserved for follow-on investment, and no single company will represent more than 50% of total fund commitment. Although we focus exclusively on Japanese B2B software, we will diversify across finance and accounting, HR and payroll, procurement and expense management, vertical SaaS, and data security and compliance. We target gross MOIC of 2.5 to 3 times and a gross IRR of 20 to 25%. After fees and carried interest, our target net return is 2 to 2.2 times MOIC and a 60 to 80% IRR. We expect average holding period of approximately 5 years. Our exit strategy is based on creating optionality from first year of ownership. The first route is ecosystem to acquirer. We build commercial relationship with potential strategic buyer well before the formal exit process. The second route is to make each company IPO ready without becoming dependent on the IPO. Or third, we maintain product-level financial information and the modular business structures, allowing either a full company sales or a partial exit. Finally, for exceptional business with significant remaining growth, we may consider continuation structures while providing existing LPs with liquidity options. Our priority is strategic sales, followed by a secondary buyout, an IPO, and finally a continuation or partial exit. Exit preparation begins year 1 and formal readiness begins in year 3, and the primary exit window is between year 4 and 6. Finally, I'd like to summarize the proposal fund terms. The fund is targeting 30 billion yen with a hard cap of 35 billion yen. It will have 10-year terms with 2 possible 1-year extension and 5-year investment period. The management fee will be 2% during the investment period and 1.5% thereafter. Carried interest will be 20% following an 8% annual preferred returns under a European Hall of Fund waterfall. The GP and senior investment team will commit 2% of total fund commitment, ensuring meaningful alignment with our LPs. LP protection include a full clawback, management of fee offset, a key person clause, and LP advisory committees. Inoue Growth Partners combine an attractive structure market opportunity, disciplined downside protection, and a differentiated operating strategy. We invite you to partner with us in building the next generation of Japan's back office software leaders. Thank you so much.